Should the proposed change be made? Now, this is what we are supposed to be calculating in this question. Now, which we need to look at the change that they are talking about. Greedy Limited is considering a proposal to change its credit policy. It's changing a credit policy, and it is from allowing debtors credit of 2 months to credit of 3 months. So it's planning to extend its credit period from 2 to 3 months. The current sales figure 600,000 per annum, and as a result of the proposed change, it will increase by 15%, and the contribution to sales ratio is 20%, and the cost of capital is 10%. So we have to state whether this change should be made or not. So let's look at the impact that this policy is going to have on the profit of the company, and if the profit is going to increase, we will recommend this change to be implemented. So one of the obvious increase in costs will be in the form of finance cost. So let us first calculate existing finance cost. Now for existing finance cost, we first need to find out the existing account receivable. Now the existing account receivable must be equal to 2 months worth of sales. The total sales figure is $600,000, and that is for the whole year, which means it's for the 12 months. Now if we divide it by 12, we will get the per month sales, and we need to multiply it by 2 to get it equal to account receivable figure. So from the annual sales, we are converting it into 2 month sales, which will be the receivable balance, and then we need to multiply it with the finance rate of the company, that is 10%, to find out the existing finance cost. And if we solve it, it is going to be $10,000. Now let us calculate the revised finance cost. For that, we need to find out the revised account receivable figure. It's the revised finance cost. Revised finance cost. And for the revised finance cost, we need to take out the revised receivable figure. The existing receivables are 600,000. Sorry, the existing sales are 600,000, and it is going to increase by 15% as a result of the change in policy. So it will be 15% more than the existing sale. That's why I'm multiplying it with 1.15 to include the 15% increase in sales. And then again, I have to divide it by 12. But this time I need to multiply it by 3, because the revised policy is to extend the credit period for 3 months, and then multiply it by 10%. So if we multiply $600,000 by 1.15, this will add the additional sales as well, and it will give us the total sales figure after the policy. So 600,000 into 1.15, it's going to be 690,000 divided by 12, 57,500. That's going to be the monthly sales figure, and multiplied by 3 to get the revised account receivable figure, and that will be 172,500, and then we should take 10% of it. So the revised finance cost is going to be 17250. So there is an increase in the finance cost of 7250. So if the company proposes this, implements this change, it is going to have additional finance cost of 7250. Now this is going to be compared with the benefit that this extension in credit period is going to give to the company, and the benefit is in the form of additional contribution. So the sales figure, the existing sales figure is 600,000, which will result in additional sales of 15%, and that is going to be $90,000. But as you know that additional sales will always call for additional variable cost, therefore we should pick up the contribution rather than the sales figure, and the contribution percentage is 20%. So the contribution that the company is going to earn from $90,000 additional sales will be $18,000. So on one hand, it is going to increase its profit by 18,000. On the other hand, this Cost is going to reduce the profit by 7250, so the net impact will be the difference of these two, and it will be $10750. And since it's a net benefit, therefore the company should implement this change.